Client Officer at NZ Funds. And together with me, I've got James Grigor, Chief Investment Officer. Today we're joined by Zoe Wallace, Chief Economist at Deloitte. Before joining Deloitte, Zoe had an impressive career working internationally in New Zealand in roles such as the Chief Economist at kiwibank, Director for the CFA Society of New Zealand, being responsible for leading women in finance, and a portfolio manager at the Reserve Bank of New Zealand. It's really great to have you here, Zoe, and we're very much looking forward to getting your take on the economy and where things are going. But before we kick into that, it would be wonderful if you'd talk us through your journey so far, how you find yourself at Deloitte, and then what it is about economics that you love so much.
Yeah, sure thing. So I started my career journey at the Reserve Bank as a graduate. So I think when you leave university with an economics degree, the two main places that people end up tend to be the Reserve Bank and the Treasury, and I was lucky enough to end up at the Reserve Bank, which I really, really enjoyed. It was a fascinating time actually, and I'm probably showing my age a little bit, but when I joined, I think within the first year, basically the global financial crisis hit, and things got really, really interesting. And I was actually based, rather than the economic side, in the financial markets team and actually doing financial market research. And I remember went on holiday. While I was on holiday, Lehman Brothers happened, came back straight into a new role doing market research. And it's interesting, you learn all these very theoretical models at university about how the economy should work, and then you live through a financial crisis and realise that a lot of those go out the window, and actually a lot of it's down to human behaviour and risk aversion and fear to some extent, in terms of how the markets reacted and what the sort of contagion effect from Lehman Brothers really spilled over into lots of other areas. So that was a really fascinating few years, baptism by fire. I then headed off on the traditional, UK OE thing, and ended up doing a couple of contract roles, still in financial services over there, before coming back to portfolio management role at the Reserve Bank again. Then an opportunity came up to do some more bread and butter economics and actually be a sort of bank economist at kiwibank. So I joined that team and spent about 6 or 7 years of my career at kiwibank, which was a fantastic experience, really cool, social mandate as well in terms of what kiwibank was set up to do in the organisation and how it operated. And ended up sort of leading the economics team there for a few years, which was great. So doing Chief Economist role there, which was quite similar to what I'm doing at Deloitte now. But in the interim, I actually had 2 years running their payments and transactions portfolio as well, so heading up that sort of customer strategy and product division of kiwibank, which was fascinating too.
So not just the theoretical, but the practical right in there?
That too, yeah, which is really interesting.
It's great. So in your current role, you do client-facing work as well as forecasting and that side of things. What particular are there particular sectors you focus on, or particular clients you tackle problems for?
Yeah, absolutely. So we have a real mix. So private and public sector clients. We're based in Wellington, so quite close to government side of things as well. But we started off as a relatively small economics team about 5 or 6 years ago, and we've been growing out our base ever since then. And so it's a real range of work, as I think you end up doing a lot in consulting, really interesting stuff that comes along. So lots of sort of macroeconomic forecasting, quite a lot of microeconomics work as well. And thinking about things like cost-benefit analysis, work for different business cases and projects. One really interesting piece that the team did recently was around uncertainty outlooks, and so I think you can appreciate at the moment the world's becoming a lot more uncertain from an economy point of view. That has relatively large flow effects to what happens here in New Zealand. And so actually thinking about, well, okay, it's fine having a central view and a central scenario, but what does the range look outside of that central scenario? What might be a high, positive upside surprise? What might be a nasty negative downside shock? And what would that mean for different businesses and their balance sheets and how they think about their strategic outlook and adapting to that different environment? So that's, I think, a really interesting piece at the moment, given just how uncertain the economic environment is. There's a real demand for that type of analysis and understanding and thinking a bit more strategically in terms of your business planning.
Fantastic. We will launch into the uncertainty element soon, I'm sure. But before we go there, two things. I guess, obviously, you've been in economics for a number of years now. What was it that drew you to the subject matter in the first instance? And there aren't I hate to say it, it would be a good segue to the next topic in a second, but there aren't that many women in senior roles in economics in New Zealand, and so it's obviously taken you there. Where did the love for it come from?
Yeah, it's a good question, and I wish I had a more very thought through 10-year career plan. But at school I was doing largely science and maths subjects, but quite enjoyed English. Thought maybe I'd do law. Had to pick up a final year subject because I dropped a couple of different ones and picked up economics, and then just thought this is really cool. This is a really interesting business, real world application using some of those maths and other skill sets to analyse different problems and different ways of thinking, and it just kind of felt like it touched on everything, And part of the reason I'm drawn to macroeconomics is I love that big picture top-down view, so thinking about actually from the sort of balcony, how is this going to impact things, and how does that impact different businesses' outlooks? What does it mean for the consumer? At the moment, we can probably come back to this, but you think about cost of living crisis and what inflation numbers actually mean for your people on the street. And so, it just really appealed from that point of view. And so I ditched the idea of doing law and picked up economics at university and kind of went from there.
Zoe, when you think about your macroeconomics journey, and when you think about some of the great economists out there, lots of economists end up sort of coming down on one view or another, or multiple views. You can be a Keynesian or you can be a neoclassical. Is that how you think about things, or is yours more, I guess, like a good journalist? You're sort of open-minded to everything, and that the research will take you down either way. How do you think about that? Because you get some real, in a good way, opinionated economists, but you also get, in your role, I guess that's quite hard to have.
Yeah, it's interesting. I haven't actually thought about what sort of economist type I am, but I think I probably would say the latter is that I don't have a strong sort of everything's right this way and you must think about things in this model. What I do think is really interesting, and I sort of alluded to this before, is that you need to think about economics in the context of people and how people actually behave. So I do really love that behavioural finance, the Richard Thaler, the nudge, that school of economics is that actually, okay, there's a model about how things should work if everyone was rational, but actually people aren't rational. People make silly decisions or things that might seem to conflict with what they've said previously all the time. So thinking about actually from a real world point of view, okay, what are the contagion effects if you implement that policy versus this policy? What are the flow-on effects? How might people not act in the way you expect? And I think, even doing a sort of customer product-facing role, you think you know what might work, but you actually need to go and road test that and actually see what demand is for a product, or how customers might actually end up using these different offerings that you have, and thinking through the sort of ramifications of it and road testing and really trying to embed economics in the real world.
Yeah, that's exactly the same. Obviously, I didn't do economics, which I'm always very quick to point out. But when you're studying finance, there's one thing sitting in a room exactly and learning about how the world should work and your DCF valuation of some company and its long-term cash flows. But in reality, a lot of share prices are affected by human behaviour and management teams and politicians and that sort of thing. Yeah, Reddit, exactly right.
Surprise, another Reddit post moved Google, $20 billion or something. So, cool. You've also been a big advocate for women in finance, and part of that was your role with CFA, Society of New Zealand. And I thought it might be a good, just a little bit of a stock take. We pulled some numbers together. I think currently, based on the data, we've got something like just short of 26% of directors on private company boards are women, and 29% of NZX 50 directors are women. And meanwhile, so that it's probably improving, but it's not a huge number. Nearly a fifth of companies on the NZX have no female directors, and so that sounds pretty dire. But on the other hand, in public sector boards and committees, apparently 53% of directors and committee members are now women, according to the Minister for Women, Jan Tiniti. So how have you thought about, advocating for this in the broader community and encouraging participation and as part of your role at the CFA?
Yeah, it's an interesting one. When we started thinking about it from a CFA point of view, it was kind of a question about at what point down the sort of career spectrum you ended up needing to intervene. And what we found was that often the problem was people leaving school hadn't done enough, hadn't picked maths subjects or hadn't picked the right things to then get them on the path. So even if they were doing a commerce degree, they might not have enough maths to do an econometrics paper, for example. And so it was almost you needed to go right back to school age. And I think, there's some great programs happening, banking around financial literacy and understanding being one of them. Kiwibank partners with them to help support that. And then the other piece is just thinking about, okay, how do you get more females studying STEM subjects, basically? Because I think that's a natural flow onto being, to a career in finance from some point of view. So if you look at the stats at uni around commerce, women in commerce, they actually look pretty good, but when you deep dive into which streams of commerce those females are taking, that's when you start to see the discrepancies arise and you don't see 50-50 splits in subjects like finance or economics. It is getting better and I think it has improved since I went through. But it's definitely still a work in progress. And I think, part of it's role modelling. We've got some great senior female economists now in New Zealand. Sharon Zoe Wallace at ANZ. There's more senior CEOs on the bank boards now, bank leadership now as well. So that's been a great thing to see in terms of just that role modelling piece. But I do agree, boards is still an area where we need to see more change. And it is happening, but it does feel slow, right? It's also that pipeline as well. You need more women in senior positions getting the right experience to then move into board leadership roles. I don't think there's a quick fix, but I think, role modelling does play a really huge part in it. But then on the flip side, if you look at things like accounting and law, which used to be male-dominated, hugely male-dominated 20 years ago, you now see more female graduates come through law, and accounting's, I think, about 50-50 nowadays as well.
I went through law school and I think it was 60 in my contract class. The numbers were done over, it was 63% females and 30, whatever the difference is, 37% males. And so I was severely outnumbered in that one, but that's a very small group of people, really.
Yeah, law's actually started to flip the opposite direction. You've got more females than males, right?
Yeah.
So, those industries have seen a huge amount of change and that's really positive, but obviously it's still taking some time, I think, to come through when you look at, senior partners at law firms, general counsels. So it's a slow burn. I think we're heading in the right direction, but we've got to think about particularly capturing people at a younger age and just making it clear what your options are as well. I think at school it's really hard for school leavers to see defined careers. And there's so many roles that you don't understand or don't hear about or don't know about until you get out into the workforce, and therefore having the foresight or having the insight to be able to say, actually, that looks really cool and I'd be interested in doing that. How do I get there? Yeah.
Cool. Well, work to be done, but hopefully it is heading in the right direction.
Yeah.
All right. The world faces a wide range of economic headwinds currently, and uncertainty on many fronts. I guess at a really top level, what's your view on us achieving a soft landing, so to speak?
Great question. So still our central view is that New Zealand would probably avoid certainly a nasty recession, possible technical recession. You might see 2 quarters of negative growth, but pretty mild. Our core view is still that we avoid that and that we sort of engineer a softish landing in the next couple of years. But that's, say, a 60% central scenario rather than anything higher. So I think if you look at the balance of risks, they're definitely to the downside at the moment. Particularly around the global growth outlook and the impact of negative shocks from geopolitics that we've seen come into play over the last few years. How far will central banks tighten and how quickly will they be able to respond once they see inflation not coming off? Because the tricky thing about monetary policy, right, is it operates with a lag. So we've had a huge amount of tightening from almost every single global central bank. But that takes time to come through. You're seeing this in New Zealand at the moment, right? We started tightening just over a year ago. We've gone from 0.25 to 3.5. We expect another 75 basis points at the November meeting next week from the Reserve Bank. So that's taking you to 4.25. That's 400 basis points of tightening in quite a short time frame. People are on 1 to 2 year fixed mortgages. people starting to roll off, doubling their interest rate, right? So it does take time to feed through, but we're expecting it to start really hitting. And it's interesting when you look at, the cost of living and consumer spending. Consumer spending has actually been holding up relatively well to date, but you can start to see the mix of that's really changing. So people aren't going and splurging on new cars and TVs and lots of DIY anymore. People are actually ending up spending more money at the supermarket and the petrol pump.
When you think about the choices of the Reserve Bank, I guess you got sort of a view of it when you were working for them, with them, but I guess there's, from this point forward, there's two tracks they can go. You can, or any central bank, not just the Reserve Bank of New Zealand. It's do you continue to be increasing rates aggressively because there might be a lag effect, but at the moment inflation's still high and employment's still really low, and so it's hard to get it down. But you might overdo it, and in which case, you potentially cause a recession because of it. But then I guess you can flip the other way and start reducing. Or the other one is to pause a bit and see how it plays out. I guess the risk there is that you haven't actually controlled it and then you're playing catch up again. Do you think about those two, I guess, courses of action and go one's worse than the other, or are they both difficult and both have different effects? Or because I guess that's the choice that all central banks have at the moment. They either see if the lag effect does come through and actually they've done enough, or they keep going because they don't want to play catch up later when they realise that perhaps they're wrong and inflation is still pretty stubborn, even though we're at 3.25 with a 75 base point raise perhaps next week.
Yeah, absolutely. I think one thing that's been quite interesting to watch here, and there's two factors that the Reserve Bank is probably quite concerned about. So one is wage growth, and that's really accelerating at the moment. The other is inflation expectations. And so those two things, once they become quite embedded, they become quite hard to shift. So inflation expectations in the latest Reserve Bank survey, you had 2-year inflation expectations at 3.662. So basically, those people surveyed think that in 2 years' time, the Reserve Bank still won't have got inflation back within its target range. And I guess there starts to become a little bit of a credibility question for the Reserve Bank in that, is do people believe that it will be able to get inflation back to its target? Because if people don't believe that, then you start to expect prices will continue to move up for some time. And then if you expect prices to continue moving higher, well, I'm more likely to put my shop price up, I'm more likely to grant people wage increases, and therefore that becomes embedded in inflation. So the longer that your expectations remain elevated, the longer inflation is likely to last and the stickier that it is. Same thing with wages, right? So if wage growth continues to go up, firms are going to have to raise their prices in response to that, because otherwise you're just eating into your margin. And if people are facing a higher cost of goods, then you're more likely to demand to pay a rise to compensate for that, and therefore you're putting more pressure back on wages. So those two dynamics are really probably what's keeping the Reserve Bank up at night in my mind. And that's what they really want to get on top of. So until we really start to see those factors cool, I think they've probably got a little bit further to go in terms of hiking interest rates. What I do think though, and monetary policy is a tricky instrument because it operates with a lag, but it also, what they're trying to do is impact the demand side of the New Zealand economy, right? So you're trying to raise interest rates to a point, but actually things start to cool. And so I think that is going to be starting to be evidenced by the time we get into the new year. And the Reserve Bank's in a bit of a different position to others such as the RBA's. RBA's, Reserve Bank of Australia, has taken a much more dovish stance recently. So they've hiked rates quite aggressively up until this point, but they're now sort of a bit more cautious about how far they want to go from here. And very much in a wait and see mode, but they have a few more meetings a year than we do. And so we've got a November MPS, and then we're not meeting again and don't have another OCR decision until February next year. And it's quite a long time between drinks, actually, for a central bank. And so what I expect is they'll hike properly, aggressively, so hike 75 basis points this quarter or this month. But by the time we come back to February, I think things will be evidencing the fact that those interest rates are starting to have a negative impact on consumer spending, business demand, business investment, and that things are starting to cool, and that will be taking some of the heat out of inflation.
That's really fascinating about that meeting, because I guess that either they have to do some, not emergency, but some out of cycle raises if things really get out of control, or go harder now at this at this increase next week and to sort of tie them over until after Christmas?
Yeah, I mean, I guess there's an outside risk they go 100. It's not. I don't think it's very likely, and it's not my central view. I think also because they'll be feeling like they're getting towards the end of their hiking cycle. So if you think about where they were forecasting, and admittedly a lot of water has gone under the bridge since their August monetary policy statement. They were talking about a OCR peak of just above 4. So we're talking about them taking OCR to 4.25 this month. So the closer you get to kind of where your expected peak is, the more I would expect them to be a little bit more cautious about quite how rapidly they're increasing interest rates, right? And starting to tail things off. So our house view is to probably see a peak in the OCR of 4.75 in sort of early to mid next year. And I think that's possibly at that point going to be delivered in maybe one more 50 basis point hike or 25 basis points, just depending on how economic data is looking at the start of next year.
The effectiveness of it would depend on the timing with which people roll over their mortgages, and I assume it's not completely linear, and there'll be a curve to it through the year. And so, and the other, I guess, key component to it, of course, is that the unemployment rate seems to not be budging. So, 75 basis points, I don't know if that's enough, right?
To put it bluntly, Zoe, do we have to see unemployment increase in order for wage growth to decrease? And that's no politician wants to say that openly, but essentially we do, don't we? We have to see unemployment rate go up.
Yeah, look, I think when you think about the Reserve Bank, I mean, technically they've got a dual mandate, right? And it's not just unemployment that they specifically target, but it is a range of labour market measures, and everything is pointing to the labour market being overheated at the moment, you could say. If you think about the natural rate of unemployment, so kind of whereabouts they're aiming for, it's somewhere in the realm, or estimated to be 4 to 4.5%, so we're at 3.3%. So obviously that's quite a lot lower than kind of your natural rate. So I think if you're thinking about running your economy at not too hot and not too cold, which is what the Reserve Bank's actually ideally trying to do, a slightly higher unemployment rate would be consistent with that, and taking some of that wage pressure out of the economy. How we get there is probably an interesting question. So there's a couple of channels, right? So partly what's causing the really tight labour market at the moment is the fact that we haven't had any immigration for the last 2 years, right? So you've just got a shortage of people. We had a net loss of 11,000 people over the last year. So actually our population's losing people from that point of view, and that means that your labour force is actually getting really constrained. As immigration starts to turn around and pick up again, hopefully that will help meet some of the skill shortages that we're seeing at the moment in New Zealand. And that will increase your working age population, and that will start to naturally bring your unemployment rate higher probably. The other piece is just around the demand side. So as the economy slows, employers will naturally probably need less people. Everything's been going, particularly in the construction industry, for example, residential construction's been going incredibly strongly for the last few years on rising house prices and strong demand. We're now really starting to see that pull back, and the expectation is that the residential construction, even though consensus is still really high, I think you're going to start seeing a pullback in terms of the actual activity delivered over the next few years. So perhaps not quite as strong demand for builders, for example. And then probably the other piece is just thinking around whether we actually start to see some substitution away from labour and towards more capital investment. So when I say that, I mean, throwing people at increased business demand is one way of solving the problem, but possibly investing in capital and machinery that could also help your firm produce goods might be an alternative. And with a particularly tight labour market at the moment, and wage prices or wages going up quite rapidly, that might be an alternative that some firms look at, and that might actually start to alleviate some of the demand pressure.
And that helps a lot with productivity and things, doesn't it, as well?
Yeah, exactly, yeah.
One interesting part that I was sort of looking at within the labour statistics is, and again, hasten to add, this is your domain, so correct me if I'm wrong, but participation rate went up, and that in general terms can be a really good thing, but actually it was participation from really young people. And are we getting some unintended consequences of people going out into the workforce perhaps early because of the cost of living, and actually it might have some consequences down the road with different parts of the economy when participation rate increases, or people just getting second jobs, as well as the fact that young people perhaps leaving school or leaving not going to uni or what have you, and go getting a job. Is that anything that you've looked into over the course of what's been
I
happening?
saw the data as well. It's quite interesting, and obviously you can't tell what the driver is from just seeing the numbers, unfortunately. I mean, it's hard to tell if it is people, family pressure and cost of living is going up, we need you, a 16-year-old, to go out and get a job to help support family, or whether it's actually partly, people are just being attracted to the labour force by relatively high wages.
Wages are high,
yeah. Demand, right? Yeah, I mean, I think, you look at, particularly the hospitality industry, there's a real lack of staff, so I think possibly what you see is a substitution away from international visitors and tourists coming in and working for a year or so in the hospital sector to younger people in New Zealand being drawn into that industry because there's just really strong demand and we can't find people. One of the interesting things actually in the participation stats was also looking at more older people staying in the workforce as well, and female workforce participations hit a record high, which is really interesting to see. Quite cool. So I
It's the
think
golden age for school leavers, really, isn't it? It's the golden age for school leave. Shortly after I went into the workforce, the GFC kicked in, and suddenly it definitely didn't feel like that for my peers at the time.
Well, when I worked at Workforce for $6.90 an hour, I felt that inflation has kind of changed that. For those people leaving school and getting summer jobs, must be pretty attractive.
Yeah,
in my 420
wage increases, all of those bases. Yeah, it's a pretty good time to be looking for a job, really, in this tight labour market.
Which I guess is a good thing, but also a bad thing when it comes to inflation expectations and interest rates, and therefore the follow-on effects on mortgage rates, etc.
Yeah, exactly. I mean, a tight labour market does mean that, if you're wanting to attract workers, you're having to offer increased salaries, and that kind of becomes embedded in your prices as well. And so that, everyone's talking about the wage price spiral at the moment. And sort of alluded to this before, whereby, your expectations start to push prices up, which starts to push wages up, which pushes more pressure on prices. And that's a pretty nasty place to be. So, as I say, the Reserve Bank will be really cautious about wanting to get on top of that and make sure that they rein in expectations going forward, and that actually people are genuinely looking at inflation getting back towards 2% over the longer term.
So, sorry, I totally interrupted your train of thought, but I'm going to ask a challenge question then. So it sounds like really low unemployment, a wage, I'm not saying we're in a wage spiral yet, but there's the concerns about that, and we have inflation expectations still for 2 years out, still stubbornly high. How do we get a soft landing in that context? Because you either keep hiking rates and all of a sudden you've done it too much and you're sitting there and all of a sudden unemployment spikes because employers can't afford to hire people, or housing market goes down and consumer spending, the implications and the follow-on effects is where economics sort of loses me a bit. But how in your model have you got a soft landing when things seem pretty tough out? Not tough now, but can be pretty tough in order to control it.
Yeah, I think, so when we look ahead, we think about where growth is going to go. We're talking about, GDP growth averaging around 2% year on year over the next few years. That's relatively low compared to where your kind of natural GDP rate would be, and that means that we will be operating with more spare capacity in our economy. So as that demand pulls back in response to higher interest rates, that will open up capacity. It will mean that your unemployment rate is probably going to increase because of that lower demand coming through. But that also means that inflation pressure will come off, and that's what the Reserve Bank's really trying to get to. Doing just the right amount of monetary policy to get that outcome is quite tricky, but it does, I think that...
Understatement of the century.
This goes to my point earlier about, I think, by the time we get to February next year, the Reserve Bank is going to be much more cautious about how far it needs to hike rates in order to get inflation down, because I think that really will be having an impact on people's behaviours by that point. That's why we've got 4.75 as our OCR peak, and other people have it a lot higher. So, I think the market consensus is somewhere around 5 or slightly higher than that in terms of how far the OCR needs to go. I think you're already starting to see the signs of the negative impact that's having. The other piece we haven't talked about yet is housing, of course, and the fact that house prices falling, you're getting quite a strong negative wealth effect coming through for people. So if my house has gone down 20% 20% on paper, I'm feeling less wealthy than I did when it was going up by 20% year on year on paper, right? And that has particularly for New Zealanders who have a lot of wealth tied up in the housing market, and you look at some of the household wealth stats from Stats NZ as well, our actual household wealth has been declining over the last few quarters, partly because of the negative impact of what's been happening in share markets, but largely because of what's been happening in the value of housing. So I'm feeling less wealthy than I did a year ago. I'm less likely to go out and spend on big ticket items, and that is a natural flow effect in terms of pulling back general demand and general consumer spending in the economy.
That's fascinating. So both those things reduces demand and GDP, which automatically puts capacity back into the market by design, and so then you get that sort of bit more leeway around wage expectations, etc. Even though GDP is still positive.
Yeah, exactly. I mean, I think when you think about an economy operating above capacity, so if I'm a business producing widgets, I'm seeing really strong demand for those goods. I'm much more comfortable putting my prices up because I almost can't keep up with demand, right? So I'm like, well, I can make more money by putting my prices up, but also probably my costs are going up because I'm having to
pay more,
draw in extra capacity, pay extra people to help meet that demand, right? But whereas the demand is below my capacity, I'm much less likely to put prices up, right? Because I'm producing more goods than people are prepared to pay for at that point. So if anything, I might even put my prices down. Unlikely, prices tend to be sticky and that they don't tend to fall, but...
Was it bowling ball bearings and feathers or whatever the case is that prices go... I forget what the terminology. It was an economic. I'm starting to really scrape the bottom of the barrel of my economic metaphors. But that prices at least stable stops inflation because. It's when you're sitting at OCR of 375 and thinking the market's thinking 525 as its peak, yet you're seeing what's going on out on the street in mortgage rates, etc. already. I sort of agree. It's kind of surely you're starting to get a decrease in demand at that point.
Yeah, and I think, when you look at when you look at the mix of consumer spending, and certainly where we expect people to be spending over the next sort of 12, 24 months, I think that mix is going to be much more consumer basics, consumer staples, discretionary items go out the window. One thing that's been interesting post-COVID actually has been the shift, though, in terms of people spending, for example, particularly when lockdown finished, right? Everyone was going out to dinner, going out eating and drinking. You've seen a shift more recently as lots of events have started to happen. So, lots more concerts, gigs, people going to sort of film festivals, all of those sort of ticket sales have been really going up quite rapidly. So people are actually spending, that shift in spending has moved away from consumer goods and particularly, perhaps large ticket items towards more experience-based. And so that's going to be interesting to see whether that holds up as kind of the mortgage rate increases really start to bite on consumer spending as well. The other positive impact, though, for the New Zealand economy is we have seen tourism come back over the last 6 months. So that's, it's not a huge wave as yet, but it is really starting to come through, particularly in some of the data. So tourist arrivals with, resumption of cruise ships coming through. Big boost to local economies from that as well, which is a piece of our economy that's been missing for the last 2 years, and we've actually managed to survive despite that being missing, partly because New Zealanders can travel overseas as well, so that 5 to 10k you might have spent on an overseas holiday has been used to buy
on spa pools. I've spent on spa pools apparently.
Yes, that's another big one. Yeah.
So when we think about tourism, does that? What another interesting stat that I read, I think it was during COVID, was the percentage of the workforce that is backpacking holiday visas. People come here, under 30 workers that come on the 2-year holiday visa. And I guess increasing in tourism does perhaps help with that, because you come over here for a holiday and go, actually, it's quite nice here. I might stay, if you're under 30, I might stay a little while and get a job in a bar or in a restaurant or whatever, so I can afford to live here for a bit. Is that the way that you look at the migration vis-a-vis tourism, or are they quite separate?
No, there certainly is a little bit of that. I think what's going to be really interesting is what comes out of the MB's consultation around immigration settings at the moment. I think what we saw was, prior to COVID, there was a lot of discussion around over-tourism and really high immigration. Those obviously both got completely switched off during COVID, and it was kind of a bit of an opportunity for us to think and reset how we want to approach that going forward. What's becoming apparent at the moment is that we are screaming for labour, and probably some of that is what we're going to need to import from overseas. So I think if you talk to any business, their number one concern at the moment is labour shortages and staffing. So we can't instantly conjure up a pool of more workers from New Zealand, so we need to think about what our immigration settings are going forward and making sure that they're the right areas we're growing in, meeting demand and helping local business through that. I think, the tourism does help to some extent around, certainly it's almost a marketing exercise as well, right? If you come over to New Zealand on a holiday and you see how beautiful it is, you might go home and then go, actually, I want to shift my whole family over and look at how you might do that over the next few years, and it's not an instant thing. But there are also the backpackers who stay on and get hospital jobs, etc. But the immigration settings and the visa requirements around that are getting tighter, I would say, probably.
Every time I turn on the radio, I hear advertising for Western Australia and to go and become a tourist worker or a hospital worker over there. So it's a competitive market for those people, and even for Kiwis. Australia's a tempting place.
Yeah,
so,
it really is. And Australia has actually done quite a proactive job of turning the tap back on in terms of inbound workers. They're facing the same labour shortage as we are, I think, largely, but they've quickly turned their immigration around, so you can really start to see the worker and the student visas coming through quite rapidly in Australia. We haven't quite seen the same level of pickup here, but I do expect it to come.
Well, it might play into their dovish stance you were mentioning earlier. This is all kind of, in a way, can be a lens to look at it as through the dual mandate that the Reserve Bank has. And would you mind just, I guess, for listeners, talking through what that means, and then sharing if you have any views on whether that is actually, the right thing? It's obviously garnered a fair amount of controversy over recent months.
Yeah, sure. So when we say dual mandate for the Reserve Bank, what it used to be was that the Reserve Bank was solely charged with keeping inflation between 1% and 3% and ideally around 2%. That sort of shifted actually quite incrementally over years with, then it was the financial stability mandate as well. There was talk about, I can't remember the exact terminology off the top of my head, but, around asset prices and having consideration for what monetary policy and how that impacts the housing market or asset prices more generally. And then we had the addition in the last Reserve Bank Act of a dual mandate around trying to keep the labour market not too hot and not too cold is probably the easiest way of putting it. But what it essentially means is they look at a suite of labour market indicators, but probably from an unemployment rate point of view, as I mentioned, around 4 to 4.5% is around that not too hot, not too cold point of view. So typically, hopefully, inflation and the labour market do tend to act sort of hand in hand in step. We haven't actually really encountered a point where those two things have been in sort of contradiction with each other as yet. So if you think about it at the moment, we've got really high inflation and really low unemployment, really tight labour market. So your natural response to either of those things would be to raise your OCR, and that's what we've got happening at the moment. It does mean the Reserve Bank's got to keep in mind a wider range of factors, and when it's looking at monetary policy and where things are going and heading in the future. I think when you think about the labour market, it was always implicitly in their considerations about where inflation was going, because that was a big driver. But it's just made it really more explicit, and it's quite a common thing. So the Fed has a similar mandate, the Reserve Bank of Australia have a dual mandate as well. So it's not hugely controversial in terms of the way it should operate. If it does get to the point where those two things are at quite opposing angles, then it'll become a bit more interesting. I think probably from a general public point of view, though, there's probably less understanding around what that unemployment or the employment labour market mandate means. So people kind of get inflation. So CPI between 1% and 3%, ideally at 2%. That's what the Reserve Bank's aiming for. But there's no kind of one number on the employment side. As I say, it is a suite of kind of how tight or how loose the labour market is, and the Reserve Bank do publish a range of those indicators. But if I person on the street, what does a Reserve Bank have to do with employment? I think probably most people would say the lower the unemployment rate is, the better, which is not actually what their mandate is, unfortunately, which does create tension from a political point of view, as you can have seen in the media recently, right? Is no one wants to think about an unemployment rate going higher, but unfortunately that might be the end result of the fact that we have a really tight labour market at the moment, and we need to get inflation back under control.
The government's books are looking pretty good at the moment from most people's accounts, and at the same time you've got obviously inflationary pressures across the board, but spending is set to continue, and there's a bunch of initiatives underway that they're looking at. How do you think about government spending during times like this, and what happens when you know it's going to inflame or add fuel to the fire potentially with some of the initiatives?
Or just ask Elizabeth Truss,
for example. Yeah. But on the other hand, some of them are really important projects. Transport, the transition to cleaner energy sources, obviously investment in education, those types of infrastructural spends. How do you think about it?
Yeah, sure. And I might go back a step to kind of what happened during COVID. So obviously you saw a huge amount of monetary policy support and fiscal policy support, right? So from the government side, particularly the wage program, that pumped a bunch of cash into the economy, a bunch of money. And I think given, and there's obviously a lot of speculation around this at the moment, but given where things looked in terms of how the economy could have fared through COVID, that was probably the right policy to roll out given the information that they had at the time. So huge amount of stimulus into the economy. What you're seeing now is that largely most of those government programs have rolled off, the last one being the transport subsidies that kick off, I think, come off in January. And that's pretty much the end of kind of the emergency support policy settings that we had in place through COVID. Then it's much more moving back into a BAU operating environment. And I think, New Zealand's facing quite a large scale infrastructure deficit. There's a lot of work that needs to be done. And part of this goes back to that migration story as well, is that we had a huge population influx and we weren't really planning or accommodating that in our infrastructure planning at that point. And immigration, can be very volatile, and we've seen that historically. But given where things got to in terms of the net additions of people, our population was growing at above 2% year on year, largely due to immigration. We hadn't quite planned for that, and so they're now sort of catching up on that infrastructure deficit, and there's a lot of work that needs to be done, and a huge number of projects still ongoing. And so I think from that point of view, that's a good thing, to be honest, because actually, hopefully government can help smooth through some of those demand shocks that we might see over the year ahead, because they've got a strong pipeline of civil construction that's going to go on for the next 24 through 36 months plus some. And what we've seen typically is these projects end up taking longer to actually get on board. I mean, a really good example is the Canterbury earthquake and the profile that was expected in terms of the rebuild versus what was actually delivered. I think we're looking at kind of a long drawn out investment pipeline from the government in terms of infrastructure, which actually provides quite a nice backbone of government spending to some extent if we are going to face a downturn next year, and certainly as things come off from the private sector. What we did see through COVID perhaps was some crowding out of government versus private investment, is that, we had a huge construction boom. Everyone was clamouring for the same resources. No one could get materials, no one could get labour. And so that was quite a tricky environment. But as you start to see that sort of private sector construction pull back, you've got that government pipeline of infrastructure still coming through, which is quite positive. I guess the other bit is that, the government spent up quite large through COVID, and their policy was always to try and get back to a more balanced budget following that. What you've seen in terms of tax takes and things like that is they've actually are running ahead of where they thought they'd be at this point in time. But if we are going to face another nasty external shock, for example, it's quite a good place to be, is getting those buffers back up. So if they needed to roll out more government support in the future, they've got the buffer to do so without having to borrow.
And when you spend infrastructure, Zoe, that's not part of your budget surplus or deficit, is it? It's capital spending, and so you can still have your tax take and your day-to-day government spending and have a surplus and pay down debt, at the same time be spending capital expenditure on infrastructure and
yeah, the
bridges?
majority, well, they've already allocated their capital expenditure budgets, right? So that's not going to change. And I expect that in the next main budget they will be adjusted. It's typically how it works, but yeah.
Because I guess there's sort of putting politics aside, there's always an argument in New Zealand that we have a lot of government spending on both sides, both sides of the divide in the political spectrum. But actually, we've been a pretty disciplined country in having surpluses, other than a little bit during the GFC and obviously COVID. That actually budget surpluses have been sort of the main course of events for New Zealand, compared to, say, the UK, which is going to be in budget deficit forever, it seems, austerity forever, but still can't get their books into surplus. Is that a fair enough sort of summary of the landscape on surplus versus deficit and government spending?
Yeah, I think when you think about the post-GFC period, we certainly had quite a reasonably responsible fiscal debt-to-GDP ratio. We've never really got to the level that we saw a lot of other countries did in terms of government support post-financial crisis. And then that was brought back over time into a more sort of balanced budget. We sort of got back into, around the 20% debt-to-GDP ratio, which everyone talks about, and they've just changed the focus on that. But I think generally we've probably been more fiscally responsible throughout the last sort of, 10, 15 years almost, than some other countries have been. And our economies have held up really relatively well as well. Like when you look at actually our growth outlook, that feeds into the government tax take, obviously. So the fact that we've never, we haven't really had a huge major recession since the GFC, and even then it was relatively short-lived and kind of bounced back out within a reasonable period. Whereas other countries, particularly Europe, depending on where you look, has had quite a long, troubled decade. The UK is obviously facing a lot of structural problems, and political environment as well. And so I think, we are relatively lucky in that we have wiggle room to respond, and that was what we saw in COVID, is that we're in a relatively good starting position from the government books perspective to then provide that additional support that meant that we didn't really experience a serious negative recession or a long-lasting one in New Zealand. And so by getting our books back into black again, gives us that opportunity and that buffer if we need it.
All right. You mentioned obviously you're really interested in the macro piece, and there's a lot of big global macro events underway. What are maybe the top three that are sort of on your mind that you focus on at the moment? When you go to the New York Times, what part of it do you look at?
Yeah, the obvious one is everyone's watching really closely to see what inflation numbers do globally. Been really interesting over the last, sort of month in the US just to see some of that price pressure starting to come back. So there are inflation numbers, both CPI and producer price index. So what consumers pay and what producers pay, so as inputs to production, are starting to pull back, and that's quite a positive sign for the US. And everyone's now expecting that the Fed might have to, the US Federal Reserve, the central bank equivalent, might have to raise interest rates by less than they previously anticipated, which is quite an interesting flow-on effect for New Zealand and New Zealand dollar, obviously, as well, because that was something that was probably causing us a bit of concern. About a month ago, you'd had quite a nasty fallback in the New Zealand dollar, and what that typically means for us is that actually the cost of imported goods goes up, and that's a negative thing for inflation. It can be really positive for our exporting sector in that your New Zealand dollar revenues increase, but from a pure sort of inflation outlook on the trade war side, that can be quite negative because it means that you're having to pay more for imported goods, and that adds to your inflation story. So the fact that the US is now sort of perhaps pulling back and things, it looks like their inflation numbers are starting to come back. Hopefully it's also a positive foreshadowing of what might happen in New Zealand in response to interest rate hikes, but also means that some of that pressure on the Kiwi US dollar has been alleviated as well. UK is a different story, so I saw the headline inflation this week hit 11.1%. That's pretty nasty. A huge amount of that has been driven by energy and food prices, and particularly energy. And so with the war in Ukraine, that's really causing a huge issue around energy prices in Europe at the moment. I think one of the interesting things, just from a longer term trends point of view, will be in response to what we said over the last couple of years, whether people start onshoring production of energy and food in particular, and probably tech, which you've seen happen in the US as well. So the sort of deglobalization trend really coming through, and people, doing trade theory at university and haven't done probably much since, but you think about comparative advantage and people specialising on what they're good at producing, and that was kind of how the world economy was built, and everyone was just importing goods from comparative better producers. So lots of, imported goods from China because they were better at manufacturing than a lot of other countries were and could do so at a relatively attractive price point. You're now starting to see some of that reversed, I think, as people get much more cautious about being reliant on offshore countries for production, particularly of kind of acute, really high demand goods, so energy and food being two of them.
I think that's so fascinating, Zoe, because look, I'm a massive green energy advocate, so just for the record, before my next comment, but the stopping of exploration of, say, natural gas in New Zealand is an interesting one, because the reason our energy prices aren't high in New Zealand is because we, at the moment, have our own gas, don't need to import it, but we've stopped exploring for it, and so we do become more part of the global market over time, and that's an interesting decision for any government to make on the, you're in Wellington, you probably see this every day, but the way up between making inroads into climate change at the same time as security of supply of energy is, in the end, if people's energy prices go up, 90%, my mum who lives in the UK was saying, from April, that is tough on the consumer, no matter how much you want the climate change to be sort of dealt with.
And the winters are cold.
Yeah, look, I think that's a really interesting point, James, and I think, over the last few years, as economies have been performing well, even through COVID, you've seen that really focus on greening of energy supplies and, greening of economies generally. What I worry about from that point of view is when the going gets tough and, people in Europe and the UK are going to be facing a recession probably, whether those agendas start to be sidelined because actually I'm just trying to heat my house and I can't afford to pay 3 times what I used to. And so that becomes that sees sort of the green energy push really sidelined, perhaps and sort of at least hopefully only in the short term, but I think that's a really big risk, is that everyone falls back to what's cheap and available rather than paying a premium.
And then people do what's sort of the immediate relief for their families rather than necessarily the longer term effects when the stress comes on.
Yeah, that short-termism starts to come through, unfortunately. Yeah, I think.
Fantastic. And are there any other, obviously, so you've got inflation, you've got, obviously you mentioned the UK. Are there any other sort of trends that you're keeping an eye on that are, you're excited about or keep you up at night?
I think the big other one, obviously for New Zealand, is what happens in China. So, they're still one of our major export destinations. They also have a big impact on what happens in Australia. And some of the politics are getting interesting, and I won't go into that in too much depth. It's not probably, I do wish I'd started studying a politics degree instead of just pure economics. I think it'd be quite useful sometimes. It feels like you need a degree in geopolitics to be an economist these days.
And an investor, don't worry.
What's that?
And an investor as well.
Yeah, very true. I think, you look at the Chinese growth outlook at the moment, and they've obviously taken a really hardline stance on shutting things down in response to COVID. You look at their property market, and that's got some pretty nasty flow-on effects for consumer spending and investment more generally. I do think New Zealand, I've been saying this for a while, has a comparative advantage perhaps to Australia in that we're less subject to kind of the boom-bust of their, investment programs. And from that point of view, we do have a relative advantage, but then you have seen more Chinese onshoring of things like, milk powder, for example, and less reliance on New Zealand. We've handled that relatively well to date by diversifying away or into other areas such as Southeast Asia, which has been really great to see. So I think everyone's aware that we've got quite a strong reliance on China and is cautious about putting all their eggs in one basket. But obviously what happens with the Chinese economy and demand over the next few years is going to be quite interesting to see for us.
Absolutely. Okay, Zoe, thank you so much for joining us. It's really great to get your insights and thoughts and views on where the world's going and what we're facing in New Zealand.
Great. Thank you very much, guys.
Thanks, Zoe. It's been really cool to